Changed your trading strategy 3, 5, or even 10 times? Listen carefully. You might think you're searching for a better strategy, but you could actually be trapped in one of the biggest psychological mistakes in trading. You discover smart money concepts. You study liquidity. You learn order blocks. You learn fair value gaps. You learn market structure. You backtest everything, and then you take a few losing trades. Suddenly, you think, this strategy doesn't work. So you switch, and the cycle starts all over again. But here's the question. What if your strategy was never the problem? What if you keep changing strategies because you haven't learned how to handle losing streaks, uncertainty, boredom, and the fear of missing out? In this video, I'm going to break down exactly why traders keep abandoning strategies, how social media makes this problem worse, and the framework you can use to determine whether you truly need a new strategy or whether you simply need to master the one you already have. And stay until the end, because I'm going to show you the biggest mistake that can make a potentially profitable strategy look like a losing strategy. If you want to stop jumping from strategy to strategy and start developing real trading discipline, subscribe to the channel. Let's get into it. The biggest lie every smart money trader believes. Imagine waking up every morning believing that today is finally the day. Today will be different. Today, the market will finally reward all the hours you've spent studying smart money concepts. You've watched hundreds of videos about liquidity. You understand order blocks. You can identify fair value gaps. You know inducement. You know market structure shifts. You know breaker blocks. You know mitigation blocks. You know premium and discount arrays. You know liquidity pools. Yet somehow, your account keeps shrinking. Every week, you promise yourself that next week will be different. Every month, you tell yourself you just need one more concept, one more confirmation, one more indicator, one more YouTube video, one more PDF, one more mentorship, one more secret, but nothing changes. The market keeps taking your money, not because you don't understand smart money concepts, but because you don't understand yourself. That is the biggest lie every struggling smart money trader believes. Most traders think they have a strategy problem. In reality, they have a psychology problem. The painful truth is this: the market isn't defeating your strategy. The market is defeating your emotions. Institutions don't win because they know more than you. They win because they think differently than you. They don't react. They don't chase. They don't panic. They don't become emotional after a losing trade. They don't become euphoric after a winning trade. They simply execute. Meanwhile, retail traders live inside an emotional roller coaster. One winning trade makes them believe they've mastered the market. One losing trade convinces them the strategy no longer works. One stop loss sends them searching for another YouTube video. One missed entry destroys their confidence. One fake breakout convinces them smart money concepts don't work anymore. The market never changed, only their emotions did, and that is why they lose. Knowledge is not the same as discipline. This is one of the hardest lessons every trader must learn. Knowing something is completely different from doing it consistently. Think about it. Everyone knows eating healthy is good, yet millions eat junk food every day. Everyone knows exercise improves health, yet most people never exercise consistently. Everyone knows saving money creates wealth, yet millions live paycheck to paycheck. Knowledge alone has never changed behavior. Trading is exactly the same. You may know every smart money concept ever created. You may understand institutional order flow better than your favorite YouTuber. You may even predict market direction correctly, but prediction is not profitability. Execution is. Many traders correctly predict the market, then lose money anyway. How? Because psychology destroys execution. The market is designed to test human nature. The financial markets are not simply places where buyers and sellers exchange money. They are emotional battlefields. Every candle represents someone's fear, someone's greed, someone's panic, someone's excitement, someone's hope, someone's regret. The chart is nothing more than human psychology displayed as price movement. Think about that. Every liquidity sweep, every stop hunt, every false breakout, every sharp reversal exists because humans react emotionally. Without emotions, liquidity would not exist. Without emotions, there would be no trapped traders. Without trapped traders, there would be no opportunities for institutions. The market survives because human psychology never changes. Technology changes, trading platforms change, indicators change, artificial intelligence changes, but fear, greed, impatience, hope, panic, these emotions remain exactly the same today as they were 100 years ago. This is why historical price action repeats itself. Markets don't repeat because candles are magical. Markets repeat because people repeat. Why most smart money traders fail. Ask most losing traders why they lost money. They'll blame the broker, the spread, news manipulation, market makers, liquidity hunts, algorithms, high frequency trading, bad luck. Almost nobody says, I lacked discipline, because accepting responsibility is painful. Blaming the market feels easier. But here's something difficult to hear. The market owes you absolutely nothing. It doesn't care about your mortgage. It doesn't care about your bills. It doesn't care about your dreams. It doesn't care how many hours you studied. It doesn't even care whether your analysis was correct. The market simply moves. Your job isn't to control it. Your job is to control yourself. Unfortunately, that is the one thing most traders never learn. The addiction to being right. One of the biggest psychological traps in smart money trading is the need to be right. Most traders secretly believe their intelligence is measured by how often they predict the market correctly, so they become emotionally attached to their analysis. When price moves against them, instead of accepting they were wrong, they move their stop loss, they add another position, they average down, they convince themselves institutions are simply grabbing more liquidity. Then they add again, until one losing trade destroys weeks or months of hard-earned profits. Professional traders think differently. They don't need to be right. They only need to manage risk. To them, a losing trade is simply the cost of doing business, just as a supermarket expects some products to expire, or a restaurant expects some ingredients to spoil. A professional trader expects losses. Losses are not failures. They are operating expenses. The problem isn't losing. The problem is refusing to lose small. Why the market rewards patience. Smart money concepts teach patience, but very few traders actually practice it. They say they wait for liquidity, yet they enter before liquidity is taken. They say they wait for confirmation, yet they enter because they're afraid of missing the move. They say they trust their strategy, yet after 20 minutes without an entry, they manufacture one. The market doesn't reward impatience. It rewards precision. Institutions can wait for hours, sometimes days, sometimes weeks, because they understand something retail traders ignore. No trade is infinitely better than a bad trade. Read that again. No trade is infinitely better than a bad trade. Every unnecessary trade creates unnecessary risk. Every unnecessary risk increases emotional pressure. Every emotional decision reduces consistency, and consistency is where long-term profitability lives. The real battle begins before you click buy or sell. Most people think trading starts when they open a position. They're wrong. Trading begins much earlier. It begins when you wake up, how you slept, how stressed you are, whether you're angry, whether you're desperate for money, whether you're trying to recover yesterday's loss, whether you're trading because you need excitement, whether you're trading because you're bored, all these emotions silently influence every decision you make. The chart doesn't create these emotions, it exposes them. Trading is one of the few professions where your personality is reflected directly in your results. If you're impatient in life, you'll be impatient in trading. If you're impulsive with money, you'll be impulsive with risk. If you seek instant gratification, you'll struggle to let winners run. The market doesn't reveal your strategy, it reveals your character. So before you learn another order block, before you search for another liquidity model, before you buy another trading course, ask yourself one simple question. Am I truly struggling with smart money concepts, or am I struggling with my own psychology? Because the trader who masters their emotions will often outperform the trader who simply knows more concepts. Knowledge may open the door to profitability, but discipline is what keeps you inside, and that is where the journey truly begins. Why 95% of smart money traders lose money every day? Thousands of traders open their charts believing they have finally discovered the missing piece. Some believe it is ICT, others believe it is smart money concepts. Some follow liquidity concepts, some trade order blocks, others wait for fair value gaps, some use market structure shifts, some combine all of them together. Yet at the end of the month, most of them have lost money, not because smart money concepts don't work, not because institutions changed the rules, not because the market became manipulated, but because they unknowingly became victims of their own minds. The greatest enemy of a smart money trader is rarely the market. It is the invisible conversation happening inside their own head. That conversation sounds innocent. I don't want to miss this move. This setup looks close enough. I'll just risk a little more. The market has to reverse. I can't take another loss. I need to make my money back today. These thoughts last only seconds, but those few seconds can destroy months of progress. Trading accounts are rarely blown in a single trade. They are destroyed one emotional decision at a time. The market does not reward intelligence. This may surprise you. Some of the smartest people in the world lose money trading. Engineers, doctors, lawyers, programmers, mathematicians, people with exceptional intelligence. Why? Because trading is not an IQ competition. It is an emotional competition. In school, being right earns rewards. The student with the correct answers receives the highest grades. At work, making the right decisions leads to promotions. In everyday life, people admire confidence and certainty. Trading is completely different. In trading, you can make the correct analysis and still lose money. You can make the wrong analysis and still make money. This creates emotional confusion. The human brain hates uncertainty. It desperately searches for certainty where none exists. That is why traders become obsessed with finding the perfect setup, the perfect indicator, the perfect entry, the perfect mentor, the perfect confirmation, the perfect strategy. But perfection does not exist. Professional traders understand that every trade is only a probability, not a promise. The illusion of control. The human mind craves control. We feel safe when we believe we understand what will happen next. That is why many smart money traders spend hundreds of hours marking charts, drawing endless trend lines, coloring liquidity zones, highlighting fair value gaps, labeling BOS, labeling COCH, identifying inducement, marking premium, marking discount. Soon, the chart begins to resemble a colorful painting instead of a trading tool. Ironically, the more lines they draw, the more confident they become. But confidence is not the same as certainty, and certainty does not exist in financial markets. Institutions don't know exactly what the market will do. Neither should you. They simply prepare for multiple possibilities. That is the difference. Retail traders try to predict. Professionals prepare. The addiction to finding the holy grail. One losing week. The trader changes strategy. Another losing week. They buy another course. Another losing month. They purchase another mentorship. Soon, their hard drive contains thousands of PDFs, hundreds of trading videos, dozens of indicators, countless screenshots, yet their account balance continues shrinking. Why? Because they are addicted to learning, not executing. Learning feels productive. Watching another YouTube video feels productive. Buying another book feels productive. Joining another Telegram group feels productive. But none of these activities generate income. Execution does. The uncomfortable truth is this: most traders do not need more information. They need more repetition. Professional athletes don't become champions by reading thousands of books. They master a few techniques, then repeat them thousands of times. Professional traders do exactly the same. Fear of missing out, FOMO, is one of the most expensive emotions in trading. Imagine watching USD explode upward. A beautiful bullish candle appears, then another. Then another. Social media begins posting screenshots. People celebrate huge profits. Comments flood the internet. Easy buy, told you. Without waiting for liquidity, without confirmation, without following your plan. You click buy. Seconds later, price reverses. The very move you feared missing becomes the trade you wish you had avoided.